Okay, I will make a start. Hello, welcome, and thank you for joining us today. I'm Gordon Milne from the London Institute of Banking and Finance. And before we begin, I should say we appreciate that technology and internet speeds are not always perfect. And if anyone has issues with sound or image quality during the session, there is a troubleshooting box with hints and tips above the chat box. If you do have serious problems, you can try to leave the session and log back in again. And failing that, I'm glad to say this session is being recorded and everyone will have access to the recording later this week. During the webinar, if you have some questions for our speaker, please type them in the chat box and we'll do our best to answer them in the Q&A at the end. Now, before I introduce Tony, our speaker, I would like to give a very quick introduction of LIBF and the background to the series of webinars. The London Institute of Banking and Finance, LIBF for short, is a not-for-profit charity which was founded 141 years ago as the Institute of Bankers. Today, from offices in the UK, Singapore and Abu Dhabi, we offer practitioner-led global qualifications and training to 2,000 banks and financial institutions around the world. We are the only professional body in banking or finance with both a Royal Charter and our own taught degree awarding powers. This webinar today is part of a series we're hosting to support the recent launch of a new and unique certification program in SME lending and alternative data. A certificate which we developed following extensive industry feedback about the lack of a modern, practical, globally relevant and cost-effective credit program for newer to bank colleagues covering both classic Credit 101 and the application of alternative data. In short, the program is for small business and SME focused relationship managers and credit officers, as well as central bankers and policymakers. Given the current crisis, I'm glad to say it is delivered through e-learning. Please get in touch with us if you'd like more information or trial access for the program. So, to today's webinar. I'm pleased to introduce our Singapore-based associate, Tony Deary, who, having started his career at the Federal Reserve Bank in the US, has since built a career in advising and working with commercial banks, central banks, development banks, regulators and think tanks in Southeast Asia. A key area of his expertise is around alternative data, and here he is to tell us more about enabling alternative data lending, policy and practice. I hand it over to Tony.
Thank you very much, Gordon. Well, I'm really honored to present to you all today on this webinar. As Gordon mentioned, the goal today will be to hopefully stimulate some ideas for you in these intersecting topics of SME lending and alternative data. And we'll also use this as an opportunity to highlight some of the learning objectives that will be in the course. In the last webinar, Jonathan shared his insights on alternative data from a UK perspective. But today I wanted to consider using alternative data for SME lending in an emerging market perspective, as the challenges and opportunities there will be quite different. So, just looking over the attendees list last night, I see we have folks from all over the world, from UK, Germany, Singapore, Thailand, Myanmar, Philippines. And I also noticed a wide variety of backgrounds. So we have bankers, we have regulators, and international development officers. So that's super exciting. And I hope that there are some real takeaways for everyone here today. And I just need to apologize in advance. The Singapore Air Force has decided that today is training day, so you might hear some fighter jets in the background, but don't worry about it. Okay. I want to begin today with a poll. Make sure everyone is awake, and with alternative data, there are a lot of preconceptions about what that is. And so I wanted to get a feel for where people are coming from on all this. So Rox, you've got the poll pulled up. So folks, you can just click right into that screen. And the question is rather simple. Which of the following do you think is an example of alternative data? And you can click on multiple answers there. It's not just one answer. So we've got over 100 responses. It's not surprising to me that satellite data of shipping lanes is coming in as the top choice. So yes, satellite data of shipping lanes is absolutely an example of alternative data. This is used more in an investment banking context. Investors will use that information to determine it's as a proxy for commercial activity and bottlenecks in trade supply. So that is absolutely an example. The next one, reported taxable income of a client. So this one is very, very pertinent for any kind of credit decision-making process. However, it is not considered alternative data in this context. It's rather a traditional data point that we would use. So the next one, paper sales receipts from a client business. Now, yes, this is actually an alternative data point. Now, granted, it's not digitized, and it could be digitized, but this would absolutely be an example of an alternative data point from a client lending perspective. And D, the amount of orange juice a client consumes. So not really. In a finance context, I wouldn't consider that alternative data, but perhaps if you're thinking about the Internet of Things and a futuristic environment where your refrigerator talks to you and tells you what's inside it, maybe that data point would be useful for like health apps or health insurance and so forth. Okay, so we're going to get a little bit more specific now. You can close the poll, please. Thank you. So what is alternative data? I want to make two distinctions in that context. One is we're talking about today alternative data in a finance context. So investment banking, insurance, commercial lending companies, retail lending for consumers. Those would be all relevant when we talk about alternative data. But for the purposes of today's webinar, I'm going to focus on the commercial applications, the commercial lending applications. The other thing that I want to mention here is big data versus non-traditional data. So the use of alternative data in that big data context can be thought of as data which is acquired from digital means, such as the digital footprints from the usage of mobile devices and transactions made on the internet or online. And the aim of using this data is to recognize patterns that may be useful in determining the profitability of a customer, default, and so forth. So these data sets can be characterized as being very large and complex and not handled by traditional software tools such as Microsoft Excel. Rather, this data is collected and analyzed by specialized software using artificial intelligence and machine learning algorithms. And these services are provided by a growing industry of providers that we loosely call fintechs. And I'll get into that in a moment. The use of alternative data in a non-traditional data sense can be characterized as data sources that fall out of scope of the traditional credit reporting process. So examples of this are consumer payment histories, rental incomes, utility usage, bill payments, bank account transactional data, and even data that may not be closely tied to the financial behavior of a customer, such as educational backgrounds and social media activity. And the reason we are increasingly looking at using this alternative data, especially in less developed financial reporting environments, is those alternative data points might be what makes the final difference in an approval or a rejection decision for a loan. Alternative lending techniques will apply alternative data to credit applicants, and big data techniques can be extremely predictive due to the large amount of data collected, and non-traditional alternative data analysis may improve the bank's traditional lending approach. These techniques can help banks to lend better than before, reaching more customers and lending for longer terms, while reducing the number of loans turning bad. So banks historically didn't use such data for loan approvals, maybe because the data was not available. The data just simply didn't exist because the technology that it relied on had not been developed, or businesses that generate that data did not exist, or simply banks did not recognize the value of data it already has or know how to exploit that data. So today I will lay out some options for how to leverage both these types of alternative data from an SME banker's perspective. And since the market environment where you are all operating maybe at different stages of technology adoption, there will be a myriad of options for you to consider. So I just need to run quickly through these definitions so we're all on the same page. For the purposes of this presentation, I will define financial services as commercial banking services. That's kind of your traditional checking account deposits, deposit accounts, loans, credit cards, overdraft facilities, payments, funds transfer. And I won't go into the insurance and investment banking or brokerage applications. And so when I talk about digital financial services today, those are financial services which simply rely on digital technology for their delivery and use by consumers. And these services are sometimes digitized versions of existing products, or they can be entirely new products and services that come into existence because of new financial technology. And financial technology is simply fintech. It's new tech that seeks to improve and automate the delivery and use of financial services. Just a quick note about that term fintech. From a banker's perspective, when fintech emerged in the 21st century, that term was initially applied to technology employed at the back-end systems of established financial institutions. Since then, however, there has been a shift to more consumer-oriented services, and therefore it takes on a more consumer-oriented definition these days. So in order to get a better understanding of the prospects of using alternative data, I think we just need to take a quick step back and look more broadly at the digital financial services ecosystem and see how and where alternative data is being leveraged there. So to help understand this, I've segregated financial services into some general buckets. Deposits up on the top box, payment services is the right box, lower right box, and credit extension will be kind of the left side of the whole landscape. Now, obviously, banks are not the sole provider of financial services, and fintechs can theoretically sit anywhere on this landscape. There are many actors providing both traditional and non-traditional financial services. Increasingly, we see that telecoms or telcos, social media platforms, and online app-based money transfer systems leveraging their market penetration to facilitate payment services. And as we move left across the landscape, we'll see additional online services such as e-commerce platforms and software as a service tools, like those are like cloud-based accounting or customer relationship management tools to leverage their customers' alternative data. However, they wouldn't be very well positioned to make formal credit assessments or even have the legal ability to lend. And that's where we have the interesting proposition for banks and financing companies. So the largest growth in fintech lending right now is actually happening in the P2P crowdfunding space. The year-over-year growth in that area is upwards of 40 to 120%, depending on the region. And what's fueling that is equity investors looking to intermediate risk capital into new lending opportunities identified by this explosion of fintech. However, still the bulk of credit services is carried out by banks. And this is, as you well know, because the government grants them that very special license. It's tightly controlled for those institutions to be able to create credit for the economy. And another trend we're seeing more and more is financial regulators approving full banking licenses for purely online branchless banks called challenger banks. For example, the N26 in the EU, and in Singapore, several full digital banking licenses were recently approved. One was given to a subsidiary of Tencent, another one given to Arrival, which is purely focused on SME lending. And these challenger banks will bundle fintech products from the third-party service providers that you see here onto their banking platform via open application interfaces, APIs. And alternative data in a big data context can be thought of the gas or the petrol that powers these fintechs. But that's not at all to say that you can't leverage alternative data without the use of fintechs. And we'll look at some of those frameworks in a moment. Okay, so I'm going to shift now to the SME proposition. And for this, I wanted to do another poll. So Rox, would you mind bringing up the next poll? And this one will be one answer, so you can only select one. And since we have a lot of bankers out there, I thought it'd be interesting to get a feeling or sense for what do you consider as a medium-sized enterprise based on those indicators there. So below 150,000 all the way up to 50 million US dollars. Interesting. So looks like we're getting C, which is 1 million to 10 million. Very interesting. Okay. So if we're trying to think about SME lending in an emerging market context, probably the first thing we need to do is define what that is. So, okay, I think we can close the poll. So it looks like 1 million to 10 million is the top answer. Thanks. Right, so if we take the legal EU definition for an SME, you'll see that that is, well, for the medium-sized, it's going to be around 12 million. So a lot of our respondents were coming in and around that range. But if we take Cambodia for an example, which I arbitrarily picked as a developing country example, the number of employees are exactly in line. However, the turnover definition is dramatically different. And so this has a major implication for the commercial viability of lending to today's different businesses there. If you consider that the underwriting cost for an SME alone is between $2,000 and $5,000 in the EU, you can imagine that using that same infrastructure to lend in Cambodia wouldn't be commercially viable, given that the average loan size, especially for the small enterprises, is around $50,000, with potential interest income being less than the underwriting cost in a more developed context. So there has to be a different model to improve the access to finance for these SMEs. And so here you will see very clearly the business opportunity. I put together this funding gap just to illustrate a point, and I used the volume of approved loans versus the volume of denied loans as a proxy for the funding gap. It's not perfect. There's a lot of different definitions out there, but I think the message is the same. And you can see very clearly that 80% of the loans are denied. And so in the UK, it's across the board, right? In the UK, it's 77 billion of a funding gap. In Europe, in its entirety, is around 825 billion. And I used a developing country index, which was based from an IFC definition, and it's around $5.2 trillion in funding gaps. So what's behind this is twofold. One is that banks have large cost structures, which often prevent them from funding smaller loans, such as the ones typically requested by SMEs. It takes a bank as much effort to fund a small loan as it does a large loan, and often smaller loan requests don't make it through the application stages. This is where we enter with the digital banks. And the other is that banks simply don't have enough data points to confidently identify those creditworthy SME borrowers, and this is where we talk about alternative data. The continued growth of alternative finance seems a near certainty when you look at it like this, especially in countries like the UK, where they continue to embrace deregulation and mandate policies such as open banking that will eventually promote access to information and more competition for financial services. So, and if we look at it from a developing country context or emerging market context, you can see very clearly that the biggest opportunity is in, it says East Asia and Pacific. And I think that's driven primarily by China. But you can see that there is a massive opportunity. So what are kind of the challenges that we need to overcome in these developing markets? So there's different categories. So one is more from a legal regulatory standpoint. Often we see that interest rates are fixed, tenors are fixed, and that means that there's no flexibility in the commercial decision making. There's no chance for risk differentiation. And since it's usually mandated by the government, it's not reflective of any kind of market rate. And so informal lenders tend to thrive in this environment. Then we have kind of the client issues. Financial information can be problematic, especially in markets where financial literacy and formality are low. Accounting standards and audit quality can be very challenged. And so businesses may not have sophisticated accounting information systems, and they will file, if anything at all, the minimum accounting information or tax for tax purposes, and may not even use a bank account. And then on the bank side, we have usually underwriting issues. The process is often too slow and cumbersome to match the immediate nature of the SME needs or SME funding needs. And then you will almost certainly have infrastructure issues like there won't be any online ID system or company register. Credit bureau may or may not exist and may not include SMEs. So the natural state of banking in these environments is basically what we call like pawn shop lending or pawn shop banking. If there is no movable asset register, the banks will simply take land and building as collateral and then issue standard bullet loans. So the opportunity to do that more unsecured cash flow based lending for SMEs, which is what they need, is just simply too risky due to the lack of information about the business. Enter alternative data. So we roughly define the universe of sources of alternative data, but in an emerging market context, where can we really expect to leverage this data? And that's in those circled areas. About 1 in 5 SMEs in emerging markets don't have a credit history, though they may not have a formal banking history. They do usually have some kind of online digital footprint. And in most emerging markets, mobile and internet penetration has surpassed financial services or banking penetration, which creates the opportunity for this fintech-led alternative data analysis. But the other huge alternative data opportunity in emerging markets lies inside the bank itself. In a lot of cases, the existing alternative data the bank has about its customers are not being leveraged to improve the credit scoring process. And we'll get into that in a moment. And just a note on open banking, because I've got it there in the slide. Open banking regimes are data sharing schemes that are mandated or supported by regulators with a goal of creating competition and fostering innovation in financial services. And with an open banking regime, banks and other financial institutions will exchange customer data with other financial services providers or third-party providers like fintechs, following very clear laws and regulations on consumer consent. But this is kind of, we see in developed markets. So how does alternative data support the credit process? The usage of alternative data should be thought of as complementary to traditional methods. So the cornerstones of financial analysis and non-financial analysis of a company are still pertinent and relevant for SME lending. If we had the level of data disclosure like that which we get from publicly listed firms, for example, we wouldn't actually need to rely on alternative data that much for SMEs. So what we are trying to do here is bridge that gap or the gaps in what we do have available and get that more regular insight into a smaller business since their finances are inherently less stable and more likely to need impromptu financing as a bridge to short-term cash flow gaps or to take advantage of short-term opportunities that have come up. These are the types of things that we can help address with alternative data, which goes alongside traditional data sources like the filed annual accounting statements and non-financial information, such as profile of the business, the management, geographic operating areas, market environment, customer base, and so forth. So the credit assessment is the process of gathering information about the borrower's business and the borrowers themselves and evaluating the credit risk with a view to making a credit assessment, typically expressed as a credit rating or a credit score. And so that whole credit process for SME lending is what this certification that Gordon mentioned at the beginning of the webinar is really about. The credit score, which is the credit risk rating used to determine the potential for default, is a regulatory activity that banks and financial institutions have to take, as it will determine the capital that the bank needs to hold if it makes that loan. And that is typically quite tightly controlled. An alternative data-driven model alone is not really suitable or even allowed in some cases to be used in that space. So where alternative data does come in is in the commercial lending decisions that can be made off the back of that credit score, deciding whether or not to lend to that business, how much to lend, at what terms. And this is where alternative data analysis can really help if it's employed in a useful manner. Now, also on the credit monitoring side, after the funds have been provided, you want to make sure that you are getting your repayments, right? Obviously, monitoring the financial performance of the borrowers and timeliness of payments is the traditional approach, but you can also consider monitoring alternative information, such as news stories, social media posts by the owners and employees. Even monitoring energy consumption of an SME via meter readings, which can be a proxy for industrial activity, is a way of using alternative data to better inform on the status of a borrower. Also, from a portfolio monitoring perspective, alternative data paired with demographic data is immensely helpful to zoom in and identify potential troubled clients in certain industries or business segments due to changes in the economy and unexpected macro events. So you don't want to wait for failed repayments. You can use profiling to identify upfront those issues and who might be at risk. Oh, okay, so poll time. Roxy, can you bring up the next poll, please? It's not a test, don't worry. It's all anonymous. So in an emerging market context, which of these would you rate as the highest importance for credit score? And for those of you not in emerging context, please put on your emerging market hat for answering this question. We'll just wait a minute for the results to come in. So I'm seeing financials and credit history. So supplier-buyer relationship is the least, and credit history seems to be the biggest. Okay. All right. Okay, Rox, could you close the poll there? Thank you. So that's very interesting. At the London School, at the London Institute, we looked at this in an emerging market context and generated like an average of what we saw. And interestingly, the supplier-buyer relationship was weighted the highest in scorecards, and so that relationship that with customers, target customers, previous credit terms that the client may have received, volume of goods transacted, dependence on suppliers. These can actually be very easily verified with alternative data points if the client is using electronic payment schemes. And so the next, interestingly, most important factor was the owner and management of the SME. So SME business are often best measured by the owner's reputation succession planning, involvement of family members, and other non-financial characteristics. Non-financial indicators can be predictive and remove that subjective discussion of the SME's financial statements. And so alternative data can be used to check on the director's profile, to check their suitability, verify the truthfulness of what they say in their application. And so the third is where we get to the financials, which is fascinating. And this is probably due to the fact that the financial information is often so skewed or untrustworthy in these environments. And then you can see the rest of them flowing through. Business operations or credit history was down at 11%. And looks like there's one missing there, but that's a relationship with the bank, previous relationship with the bank. And then industry and business plan. There's a little food for thought there. So next, I want to provide some examples of practical frameworks to help banks navigate this evolving digital and alternative data-driven environment. The first one, and perhaps the more obvious one, is that is a bank-led approach. And what I mean by that is to first look within the bank. If an SME has been previously banking with the bank, there is going to be a wealth of information, mainly payment information, that can be used to infer financial sustainability of the customer and ways to verify its credit application. So the kind of things that we would see here that you could leverage would be like deposits from sales of products or services. That would indicate firms' revenue, which can be compared to financial statements. And over time, you can gauge if those deposits are increasing or decreasing. Payroll, salary statements. This shows how many people the SME is employing and the amount of money that is needed to pay employees. Any kind of tax payments, income tax, social tax, value-added taxes, that will allow you to calculate the SME's revenue and profitability. VAT will help you identify how much revenue the business is making. Utility payments, the amount a business pays in electricity and gas and water can be very useful information. The SME is a manufacturing business with a large production line. Its electricity bill should be higher than that of a small family-owned business. And of course, if there are electronic payments for materials or professional services, rent, loans, any leasing payments, any other expenses, these will help to confirm the cost of goods sold or the price of raw materials and other costs which can help assess the profitability level of the SME. The other framework that I want to talk about, and this is the one we saw a lot of where I was working previously, is what I'll call it an anchor client partnership model. But of that sizable funding gap that I mentioned earlier, nearly 1/3 of those SMEs business models are estimated to be linked with either value chain or supply chains. And that creates a significant market opportunity for financial institutions. Now, this is something that's been around a long time. Large multinationals have traditionally been involved in value chain finance solutions through international banks and so forth. But in a local context, when a bank has a strong relationship with a medium to large business client who is part of the supply or value chain of a good, we can call that client an anchor client. And there's a huge opportunity to finance the SMEs who supply or buy from that anchor client. And using alternative data generated from the relationship or the interaction between the anchor and the SME can give enormous insights that wouldn't have been possible by evaluating the SME's creditworthiness on its own. The most common situation I've seen for a bank to provide financing to SMEs who supply anchors, is for SMEs who supply anchors. And these include things like pre-shipment finance to SME suppliers, which can be done on the strength of a purchase order, and post-shipment finance, which is provided through invoice discounting or factoring. And targeting these chains while leveraging the alternative data of the anchor client will offer a lot of opportunity to lend to the SME in a scalable and more risk mitigated manner. However, the due diligence of the anchor is, of course, the key building block in this framework, as a lot of the SME due diligence is essentially outsourced to the anchor. And so both frameworks, A and B, are extensively covered in the certification with examples and strategies on how to build a successful lending business. And then there is a third option here, which I wanted to discuss a bit. And that is kind of an outsourced or third-party fintech approach. Now, this has the advantage of not requiring heavy investment in new skills and infrastructure within the bank to collect and make sense of this alternative data. Alternative data is often unstructured, it's difficult to work with. So in many cases, it can be a better strategy to outsource this specialized knowledge. And also much of the alternative data that is useful for banks can lie outside the direct reach of the bank. So the most obvious example of this in developing markets is with mobile money operators, which have carved out a significant portion of the payments business. Operators such as the famous M-Pesa in Africa, which is a non-bank partnership with a telecom. They operate money transfer and mobile wallet businesses, collecting valuable customer transaction data. And that data can be used to design lending products and establish lending proxies, replacing the traditional data collected to make loans. There are a number of third-party risks associated with this, and the bank needs to consider these situations, particularly from operation risk and reputation risk, especially with going with poor performing third parties. I'm just seeing that the sound quality has gone down, Gordon. Maybe I should adjust the volume. Are we okay? Okay, good. Now, how can banks engage fintechs to win the SME business? So there are advantages that banks have. They are usually having a very captive, large customer base. They have the trusted brand of the people. They have distribution coverage. They have extraordinarily valuable free internal data. They, of course, have this access to a lower cost of funding, and they have more regulatory certainty. And then fintechs, they have their advantages, right? They're usually having a superior customer experience. They're clean, simple, and friction-free applications. They have more credit data sources. They have usually advanced or specialized risk models, risk-based pricing. They have lower underwriting costs, and potentially they have lighter regulations, although that is quite uncertain for the future, especially in emerging markets. And so this plot here, I thought very nicely summarizes the fintech options for banks to engage with. So it varies from investment of time and money required to level of integration. So at the top right, you see that a strategy could be just to full-on acquire an online player, or they could do equity investments or partnerships with a fintech, or they could just buy loans or refer the declined loans to fintechs. And then there's this one in the middle called provide white label online application underwriting and servicing. That's kind of an interesting approach. Okay. So since we have, right, I got the 10-minute warning. So I will move very quickly. We just have 2 more slides, and I wanted to get to these for the regulators on the call. There are some pretty big public policy issues with regards to the use of alternative data. There may be a myriad of concerns and responsibilities when collecting and analyzing data about people and companies. So I just wanted to highlight 2 examples quickly. One is regarding data privacy. And unfortunately, in my experience in developing countries or markets, there's not a lot of attention given to protecting customer identities. And in fact, quite the opposite happens. Customer data is actively packaged and sold in a mostly unregulated environment without much regards to customer preferences. And well, that, to be fair, happens across the board. But regulators are increasingly understanding these issues. There's an excellent study that was done by the World Bank Group that I wanted to showcase here, but that sets out to test how much poor people value their privacy and whether there is a business case for financial service providers to offer poor customers data protection. And so the results from these experiments in Kenya and India really make a case for offering customers data privacy and protection options. And what it showed is basically that 64% of customers surveyed chose a loan with a 10% fee and strong data privacy rather than a loan at half that rate, which is astounding. They also noticed that customers were willing to invest more time in obtaining a loan that offers privacy. So in Bangalore, 82% of the customers tested were willing to wait an extra 30 minutes for a loan that provided privacy protection. And the other thing it showed is that they are not so willing to share data with third parties when given an option. In Kenya, they found 40% of customers were willing to permit the sale of their financial, were unwilling to permit the sale of, 40% were willing to permit the sale, means 60% were unwilling to permit the sale of their data to third-party providers. And the last point here, I have to say, this is something that's closer to my heart. There's an inherent problem here with using alternative data in the context of bias. And financial institutions need to be very careful with their fintech solutions that they don't generate unintended consequences. And you know, algorithms that power fintech may discriminate in ways that may be difficult to anticipate. Financial institutions can be held accountable even when alleged discriminations are clearly unintentional. I wanted to get into this one a little bit more,
yes,
but given that we're running
thank you
time,
very
I better
much, Tony.
Stop there and move to the Q&A
Thank
section.
you for that
Gordon will be upset.
huge number of slides. You powered through a lot there, Tony. Thank you very much.
Pause there.
I'm conscious
Gordon,
that there's a whole raft of questions which
on the webinar?
We'll never cover in the next 5 minutes. So just to say to everybody that we will get Tony to answer all of the questions, no pressure, Tony, and we'll send a note out to everybody with a link to the recording of this and also with answers to all of the questions. But right now we do have time for 1 or 2 questions. So if I just go quickly to the list, 2 or 3 slides before the end, Tony, you spoke about white labeling. What do you think about white labeling? Is this a good model for innovation?
Yeah, so I did mention that there. So white labeling is basically when a bank simply acts as an unbranded banking service platform for fintech who wants to maybe leverage the banking license. So you can think about it if in a supermarket, you sometimes see those toothpaste that are, or mouthwashes or something that the supermarket has marketed there with their brand. The supermarket is not making mouthwash, right? They're basically sourcing that from a generic provider. And I mean, maybe it's not the best example, but essentially white labeling in banking is turning banks into more banking as a service, and where they kind of open up their application programming interfaces and they let third parties kind of build products, leverage that pre-existing banking infrastructure. So, I mean, it's sort of like the commodification of banks, right? And maybe this is where it starts to go. I guess I heard one analogy. Imagine the future of banking is more like a network of alliances rather than a single entity serving your financial life. And you may not even see the banks. They'll be in the background dealing with the regulatory process, and the fintechs will be in the front, customer facing. So that's what white labeling is all about. I don't have
here's one. Are there any regulatory sandboxes that allow commercial banks and central banks to test credit score models using alternative data? So that's a kind of contentious topic, isn't it, really? How policymakers, if they feel comfortable with alternative data?
Looking in the list here. Yeah, so the sandbox topic is very, very hot amongst regulators and fintechs. There's a few, I mean, the term sandbox can mean different things. So I just want to clarify that because from a fintech perspective or an innovation hub perspective, a sandbox would be more for the programmers to share and learn from each other. And then you have like these regulatory sandboxes, which is more where fintechs or banks will actually trial their new applications or processes there. And most certainly in both environments, they would be back testing credit scores. So what I mean by that is they'd be looking at databases of previously accepted or rejected applications and running their algorithms on those and determining whether or not it makes similar loans as what actually happened in the past. I don't want to get too much into this because we're running out of time, but Singapore is actually a big leader in this space.
I see. I think we actually have less than 2 minutes left. So what I propose to do is perhaps we should just wrap it up there. As I said, we'll make sure we answer. I think there's about 11, at least 11 questions I spot there. We will do our best to answer all of those and get them out to everybody. Thank you for attending. There will be another webinar in the series, the CSME webinar series. The next one is on the 24th of June. Speaker details, topic details to follow in the next week or so. And of course, if anybody would like more information on our certificate in SME lending and alternative data, please get in touch. There will be a follow-up email. Simply reply or send an email to us, and we will provide information about the new qualification. Thank you, Tony. And thank everybody for attending. We look forward to seeing everyone again in June. Thank you. Bye-bye.